Get ready for the ultimate tech deep dive. The news cycle is spinning faster than ever, and you need to be in the know. We've got the hottest updates, the biggest plays, and the most talked about moves in the industry. Don't miss a beat, stick around for what's making waves right now. First up, a major investor is making big bets on tech giants. We're talking billions. Plus, we're exploring a fascinating new trend in AI acquisitions. Then, we'll break down why one of the biggest names in cloud computing thinks replacing junior employees with AI is a terrible idea. And finally, we've got insights into a massive investment strategy shift. You're watching Amazon Insights, so hit that subscribe button and ring the bell so you never miss an update. A billionaire's bold tech moves. Why this matters. Following the moves of influential investors can provide valuable insights into market trends and potential future growth areas. Billionaire investor Bill Ackman, through his firm Pershing Square Capital Management, has made significant strategic investments in two of the world's most prominent tech companies, Amazon and Alphabet. In the second quarter, Pershing Square initiated a new position in Amazon, acquiring 5.8 million shares, which quickly became the fund's fifth largest holding, representing 9.3% of its value. Simultaneously, the firm bolstered its existing stake in Alphabet, adding another 925,000 shares of its Class A stock, increasing its total holding to nearly 10.8 million shares across both classes, making it the fund's third-largest position. This concentrated approach, with Pershing Square's portfolio typically holding only around 10 companies, signals strong conviction in these tech giants. Amazon's strategic investments are largely driven by its aggressive adoption of artificial intelligence and robotics. The company is leveraging AI to optimize its vast logistics network, enhancing efficiency in delivery routes, warehouse management, and last-mile delivery. With over 1 million robots now operating in its fulfillment facilities, orchestrated by its DeepFleet AI model, Amazon is not only speeding up operations, but also improving accuracy, such as identifying damaged goods to reduce returns. AI is also a significant growth engine for Amazon's high-margin advertising business, with AI tools helping merchants create more effective product listings and ad campaigns, leading to a 23% revenue increase in this segment last quarter. The company's cloud computing division, AWS, continues to be a powerhouse, with revenue up 17.5% year-over-year. Oz is at the forefront of AI innovation, offering services like Bedrock and SageMaker for AI model development and deployment, alongside custom AI chips like Trainium and Inferentia that provide a competitive edge in performance and cost. Despite substantial AI infrastructure spending, Amazon stock appears attractive at a forward P/E ratio of approximately 30, given its growth potential. Alphabet, despite market concerns about AI chatbots impacting its core search business, has seen accelerated growth, with Google Search revenue rising 12% year-over-year. The company is integrating AI across its products, with AI overviews now used by over 2 billion people and new features like Circle to search enhancing user experience. Alphabet's formidable distribution channels, including Chrome's dominance in the browser market and Android's widespread mobile OS usage, provide a massive user base and data advantage, which fuels its advertising network. Google Cloud is also experiencing robust growth, with revenue up 32% and operating income more than doubling, driven by its Gemini models, Vertex AI platform, and cost-efficient TPUs. Beyond these core areas, Alphabet is making long-term bets with its Waymo robotaxi service, expanding to new cities and advancements in quantum computing. Trading at a 2026 estimated P/E of just 19, Alphabet is considered attractively valued among major AI stocks. Audience impact. Investors are closely watching Ackman's moves, viewing them as a potential indicator of future market performance and a signal to consider similar investments in these tech giants. This significant investment activity paints a clear picture of where smart money is flowing. Next, we'll dive into a unique approach to building AI talent and the implications for the future of AI research. Amazon's AI talent strategy, the reverse Acqui-hire. Why this matters. the way leading companies acquire and integrate talent is evolving, especially in the fast-paced AI sector, impacting innovation and growth. Amazon recently made headlines for its innovative approach to acquiring AI talent, a strategy often termed a reverse acqui-hire. This method involves a large company hiring key personnel from a startup and licensing its technology, rather than outright acquiring the entire company. A prime example is Amazon's move to bring on board the founders of AI startup Adept. Following this, Adept's co-founder and former CEO, David Lewin, took the helm of Amazon's newly established AGI lab. In a recent interview, Lewin addressed the trend of reverse acqui-hires, expressing his desire to be recognized primarily as an AI research innovator rather than a deal-structuring pioneer. However, he defended the rationale behind such deals, stating that it is a perfectly rational strategy for companies like Amazon to rapidly build critical mass in both talent and computational resources. Lewin explained his personal motivation for joining Amazon, noting that he was not interested in transforming Adept into a company focused solely on selling smaller models. Instead, his ambition lies in tackling the four most significant remaining research challenges in the pursuit of artificial general intelligence, AGI. Lewin emphasized the immense resource requirements for such ambitious research, stating that each of these challenges would necessitate two-digit billion-dollar clusters of computing power. He posed the question of how else he could gain the opportunity to undertake such groundbreaking work if not through a collaboration with a tech giant like Amazon, which possesses the necessary scale and resources. This perspective highlights the immense capital and infrastructure demands inherent in cutting-edge AI research, particularly in the quest for AGI. The broader implications of reverse acqui-hires are significant. For startups, it offers a pathway to contribute to larger, more impactful projects without the complexities of a full acquisition. For established companies like Amazon, it provides a more agile and targeted way to access specialized expertise and innovative technology, allowing them to accelerate their AI development without the extensive integration processes of a traditional acquisition. This strategy is becoming increasingly prevalent as companies race to secure top AI talent and capabilities in a highly competitive market. Audience impact. The tech community is closely watching these talent acquisition trends, recognizing their potential to shape the future of AI development and the startup ecosystem. This focus on talent and resources for AI innovation is crucial for the industry's future. Now, let's shift gears to a different perspective on AI's impact, this time from a top executive on the front lines of cloud computing. Ackman's mega investment, Amazon and Alphabet in focus. Why this matters? Tracking the investment strategies of high-profile billionaires like Bill Ackman can offer insights into market sentiment and potential growth sectors. Billionaire investor Bill Ackman, through his firm Pershing Square Capital Management, has recently made substantial investments in major technology companies, most notably pouring over $1.27 billion into Amazon.com Inc. within a 3-month period. This significant allocation saw Pershing Square accumulate 5,823,316 shares of Amazon, equating to nearly 10% of the firm's total assets under management, as detailed in their latest SEC filing. This move positions Amazon as a key component of Ackman's investment portfolio. Ackman's firm also demonstrably increased its holdings in Alphabet Inc., acquiring an additional 925,000 shares of Class A stock. This boosted their total stake in Alphabet to 5,362,980 shares, valued at approximately $945.11 million. Beyond these two tech giants, Pershing Square also expanded its investments in Hilton Worldwide Holdings Inc. and Hertz Global Holdings. This diversified approach underscores Ackman's confidence in the growth and profitability prospects of these companies. Conversely, Ackman's firm executed a complete divestment of its substantial position in Canadian Pacific Kansas City, CP, selling off 14,799,796 shares, a holding previously valued at over $1 billion at the close of Q1 2025. This strategic sell-off suggests a potential recalibration of the firm's investment strategy, possibly in response to shifting market dynamics or specific company-related factors. Bill Ackman is renowned for his high-conviction investment approach, often making bold, concentrated bets. His investment history includes famously shorting municipal bond insurers ahead of the 2008 financial crisis and capitalizing on market volatility during the COVID-19 pandemic with a significant hedge. His latest investment decisions in Amazon and Alphabet, coupled with strategic divestments, reflect his ongoing pursuit of high-growth opportunities and his ability to navigate complex market conditions. These actions are closely scrutinized by the financial community, as Ackman's investment theses often signal broader market trends or validate specific company growth narratives. The move into Amazon and increased stake in Alphabet, in particular, align with the ongoing excitement and investment flowing into AI and cloud computing sectors, where both companies are major players. Audience impact. Financial analysts and retail investors alike are dissecting Ackman's latest portfolio adjustments, seeking to understand the underlying rationale and potential implications for their own investment strategies. Understanding these major investment plays is key to grasping the current market sentiment. Next, we'll hear from a top AWS executive about his strong opinions on AI's role in the workforce, especially for entry-level positions. AWS CEO on AI and entry-level jobs, a contrarian view. Why this matters. Leadership perspectives from major tech companies on AI's impact on employment are crucial for understanding the future of work and the skills needed. Matt Garman, the CEO of Amazon Web Services, AWS, recently expressed a strong, somewhat contrarian view on the integration of artificial intelligence into the workforce, particularly concerning entry-level positions. In an interview with investor Matthew Berman, Garman vehemently dismissed the idea of replacing junior employees with AI, calling it the dumbest thing I've ever heard. He argued that these employees are typically the most cost-effective, highly engaged with new AI tools, and crucial for building institutional knowledge and fostering future innovation. Garman emphasized the importance of continuous hiring and training of new talent, stating, "You absolutely want to keep hiring kids out of college and teaching them the right ways to go build software and decompose problems, and think about it." He believes that without this pipeline, companies risk a future where no one has developed the foundational skills necessary to drive the business forward. This perspective stands in contrast to some industry trends and predictions that suggest AI could automate a significant portion of entry-level tasks, potentially leading to job displacement. Despite his defense of junior roles, Garman maintains an optimistic outlook on AI's broader impact on the job market. He asserts that AI has the potential to transform every single industry, every single company, and every single job. But crucially, he believes this transformation does not necessarily mean replacement. Instead, AI should be viewed as a tool to augment human capabilities, enabling people to perform their jobs more efficiently and effectively. He encourages employees to embrace AI technology, remain flexible, and focus on how it can enhance their productivity. This stance from Garman comes at an interesting time, following recent layoffs within Amazon Web Services. While the company cited resource optimization and investment as reasons for these workforce adjustments, Amazon CEO Andy Jassy had previously indicated in a memo that AI adoption would likely lead to a reduction in certain corporate roles due to efficiency gains. Jassy stated, "We will need fewer people doing some of the jobs that are being done today and more people doing other types of jobs. It's hard to know exactly where this nets out over time, but in the next few years, we expect that this will reduce our total corporate workforce as we get efficiency gains from using AI extensively across the company." Garman's comments offer a refreshing defense of entry-level employment in an era of rapid AI advancement, highlighting the value of human capital in skill development and long-term innovation, even as the broader company acknowledges AI's role in workforce restructuring. Audience impact. The remarks have sparked discussion among tech professionals and job seekers regarding the future of entry-level roles and the importance of adapting to AI integration. These insights into AI's workforce impact are vital for navigating the evolving professional landscape. That wraps up our look at these significant developments. But before you go, let's quickly recap the biggest stories of the day. That's all the insights for today. Bill Ackman is making massive plays in Amazon and Alphabet, signaling strong confidence in tech's future. Amazon's AGI Labs is exploring innovative ways to acquire top AI talent. Meanwhile, AWS CEO is defending entry-level jobs against AI replacement while still embracing AI's transformative power. And we've seen a major investor shift strategy with a significant sell-off. Don't miss out on crucial updates like these. Like this video, subscribe to Amazon Insights for more, hit that notification bell, leave a comment with your thoughts, and follow us on all our social channels.